The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Arrowside Capital and guests on the podcast are invested or may seek to invest in companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. Currently, Arrowside Capital holds a position in Yeti, which is part of this discussion. Hello, everyone. We're here for another episode of Hidden Value Creation, a podcast on companies that we consider to be special and have unique features to their business that aren't really known by a lot of folks who look at it from the outside. Today we have a great treat to talk about Yeti. My friend Peter Benedict from Baird is on with us today, and Peter and I have known each other for a long time, and when I thought about talking about Yeti, I don't think there's any more of an expert on Yeti than he is. He'll get into his background in a minute. And it's a real pleasure to have you on today, Peter.
Thanks, Tucker. I'm pleased to be here, and thanks for inviting me.
Absolutely. So I think it would be great for you to start with your background, and also, maybe weave in how long you've known Yeti for.
Yeah, sure. So I've been covering consumer as a sell-side analyst for the past 25 years. The last 15 of which have been here at Baird. My focus has been on retail, consumer products and services. On the retail front, I'll be covering companies like Walmart and Costco, Home Depot and Lowe's, Tractor Supply. That's kind of my focus area there. But then when we turn to brands, my coverage has been a bit more focused, just really on disruptors. We're not out there covering all consumer products companies. We're just looking for companies that have very unique growth stories to them, or very disruptive within the categories in which they play. Yeti is one. I would say Fresh Pet is an example of another, brand that we follow closely that's disrupting the pet food market. So we were involved in Yeti's IPO in 2018. Actually got to know the company couple of years prior to that, so probably known them for about a decade at this point. And we think it's one of the most interesting brand stories, certainly the last 15, 20 years. We think there's a lot of growth still left ahead of it, and frankly, we think the market's undervaluing those growth prospects. So happy to dig in further, but again, pleased to be here, and thanks for having me.
Yeah, absolutely. Okay, great. Well, I think it would be good. We were discussing before, one of the things that is important to understand about Yeti is how they got the brand to where it is today. So the backstory is important to know. So you want to give us the backstory on how Yeti became sort of what it is today?
Yeah, sure. No, and like most great brands, there's an authenticity to it. And I think that comes out through the history of the business. So it was founded back in 2006 with really the idea of building a better cooler to be used on backwater fishing boats, like down in Louisiana and Texas. And the company kind of started with this Tundra hard cooler, which was a roto-molded cooler. We see those still out here today. But it was a hard cooler. It kept ice cold or frozen for longer. But it also, interestingly, served as a good casting platform for fishermen who could stand on the cooler and cast while also keeping their food and beverages cool. That was really the genesis of the company. And, the product line was a hit with hardcore fishermen, and then increasingly outdoorsmen to include the hunting community. And, basically they were creating an environment or a product category that didn't exist. There was no market for $300, $400, $500 coolers, $1,000 coolers. right? They went into the market. They understood that there was a gap or a need that wasn't being met, and introduced these products, and the consumer just went wild for them. And so, it was superior performance, which was at the heart of it, right? You used to have these old plastic coolers that you'd stand on, they'd break, they didn't really keep ice cold. But the Yeti product did. And so, they had that tagline, built for the wild. You still see them use that. That just harkens back to the legacy brand here, which was, hey, these are products that are built to perform in the wild and outperform product that was used before. And we think that was, that's really where this all began. Now, these were expensive products, right? They were $1,000 sometimes. In 2015, it was kind of the next leg of this story. That's when the company introduced drinkware. And so at $30 for, that classic Yeti 20-ounce tumbler, that, the brand became accessible to a much broader audience. You could get into the brand for $30. You didn't have to spend $500. And you fast forward to today, and this company has over 100 core items that they sell. Half of those are drinkware. And initially they were serving just the kind of the hook and bullet community. But now the brand and the marketing really focus on 15 different communities. It's out there going after the rodeo crowd. It goes after the alpine skiing crowd. It goes after the culinary world. So the aperture of this brand has been opened up dramatically. But it really all started with just an authentic product that just redefined performance expectations for hard coolers. And that brand halo has continued and persisted today. So that's kind of the backstory as I see it.
Yeah, great. Thank you for that. I guess you have a pretty good sort of 30,000-foot view of other consumer brands. How would you rate the strength of the brand at Yeti against other sort of consumer brands that have that sort of product and are trying to sell something somewhat aspirational?
Yeah, it's I rank it very highly, and it's just not my impression of it, but just we do our own survey work around it. I think a couple of metrics that I think maybe will bring the point home. Back in 2018, when they did their IPO, they had done a broad brand survey, and a popular measure that consumer companies use to measure their effectiveness or their consumer viewpoint of the brand would be the Net Promoter Score. Basically a delta of the people who view it favorably versus unfavorably. The Net Promoter Score for Yeti at the time was 67. To give you some perspective on that, Apple was around 51. Patagonia around 47. So a very, very high Net Promoter Score for a brand. We've done our own work on consumer surveys to try to understand the brand awareness out there, and then of people who know the Yeti brand, what do they think of it? And by our metric, we did this a couple years ago, consumers that we surveyed across the country were 7 times as likely to view the Yeti brand favorably as unfavorably. And that number had been improving over the last several years. So I think this Yeti brand is one of the best brands in the market, and is right up there, and again, with some of the big all-time brands that I mentioned earlier.
Yeah, interesting. Totally agree. And I think one of the things that has been impressive to me in the time that I've known the company is that they do an awful lot to really protect the brand. They sort of understand how valuable it is to their long-term success. They have not gone out and rifle fired a whole bunch of different products. But also one of the things that's a telltale sign of the brand, you see Yeti stickers and people with the Yeti t-shirts and hats. And it's a little bit like Jeep, right? Where it's got that, sort of that following, and there's a general affinity that you have for just what it stands for.
Yeah, no, I think that's very true. And I think about when we were doing the IPO for these folk for this stock. We had that conversation with a lot of people. Is this a product company or is it a brand? And we would use examples like that, like, hey, when you see people walking around with stickers on their trucks and hats and T-shirts, with the logo, that tells me it's more than a product, right? They're not saying I have a cooler, right? That's not the sticker. It's Yeti. So, the analogy I used to draw was back when we did the IPO for Under Armour, and at the time, Under Armour was very disruptive in the sporting goods category, particularly with their compression T-shirts. That was that was their hard cooler, right? That was their initial product, which could have disrupted the sporting apparel market.
Right. Yeah.
And so you go to the IPO, and investors would ask, well, just is a Nike just going to copy? And I heard Adidas is coming out with one, and like, what's so good about their compression T-shirt? And my point then was, well, if Under Armour is just a compression T-shirt company, this is not going to work, right? However, as I was looking around back then at my children and their friends and being on the kids' soccer field and whatever, these kids were all wearing Under Armour, and they wanted the logo, right? It wasn't about the product; it was about the logo and having it. And I said that's that subtle difference between a brand and a product. And I think Yeti is very much in that brand camp, just as I thought Under Armour was way back when they did their IPO.
Yeah. Interesting. I think when we think about value creation, it's all about earning a margin, so that you can then take that and reinvest it back into the business and continue to grow that top line, and then ultimately growing a profitable business will get you more value in the marketplace over time. It sounds reasonably simple, but it's pretty hard, right? Especially in the world where the internet, makes pricing totally transparent, and so you have to really have a compelling product. Yeti's gross margins are like absurdly high. They're very high relative to other consumer products, other consumer brands. And I guess it also sparks the question on, a couple things. A, how do they get away with charging such a high margin? So I'd love to hear your take on that. And then secondly, are they leaving some growth on the table because of where their price points are? Would they?
Right.
Are they ultimately benefited by keeping the prices high and making it aspirational and going in the direction of offering more product that's premium priced? Or would they benefit from having greater reach? I guess that's always a debate that's open to these companies that have this high margin.
Yeah. Well, there's a lot there. So I would say that, first of all, why? So their gross margins are in the high 50s now. If you go back to like 2017, which is the year before they went public, they were running in the mid 40s. So they've come up nicely over the last, let's call it 7 years. One of the reasons they're able to charge premium is because it's better product, right? That was the initial halo that you had with the hard coolers, and just the performance was better. And so the customer expectation was better, and the value was seemingly there. If it wasn't, these products wouldn't sell. As you fast forward to now, there's obviously competitive products that are out there that come in at lower price points. Maybe those companies operate at tighter margins. Well, that comes down to the question of, do you want a roto-molded cooler or do you want a Yeti? Do you want an insulated drinkware product or do you want a Yeti? So this idea of it being a brand is really central to their ability to charge a premium. Now, I think the initial product performance gaps that they were able to deliver with coolers, and you get the drinkware, I'm not sure that's the level of expectation or frankly what's required as they expand the portfolio outside of some of these core products. I think they just have to deliver really good product. And I think the pricing paradigm that they think about as they expand outside of just hard and soft coolers and into other categories, I'll take bags as an example. That's a category that they've been dabbling in for the last several years. These are duffel bags, and then there's, backpacks and those types of things. If you look at the price points in bags, they fall very much within the spectrum of prices that are already out in the market. They're certainly not opening price point products, but they also are not the highest priced products in the market. So I would say the way Yeti thinks about pricing their items, it's, hey, let's make sure we have a product that is, Yeti ready. That is something that delivers value to the consumer through performance, design, something that's superior to what's out there. But then we price it at a level that we think, makes the most sense. And I don't think they're dogmatic about having the highest priced products in any category. I just think they want to have the best product priced appropriately. So I think that's kind of how I think about the pricing. And these guys have been very disciplined, Tucker. They, during COVID, when costs went through the roof, right, for everybody, Matt Reinsch, the CEO, made a tough decision. He said, you know what, I'm not going to just raise prices to cover inbound freight, transportation costs that are spiking just to maintain my gross margin. Like, they got hit, frankly, pretty hard when that happened, because he just didn't think that, he thought that was transitory and it wasn't kind of a structural change in the pricing of their products. So if you think about it, I mean, Yeti, in a world where we've seen so much inflation, Yeti products have gone up at the minimus amount, which, so you could argue that the value of a Yeti product today is meaningfully higher than it was 3-4 years ago.
Yeah, that's a really good point. So the gross margins have gone up a fair amount over the last 7 years, as you mentioned. And what's been the driver of that? I mean, what are the things that they've been doing to drive that? And
Right.
How do you feel about the ability to continue to be able to do that? Or at some point, does that start to be about the level that you should expect, and then the rest of the margin will just come from growth or operational excellence?
Yeah, that's a good point. So I'll start with a little perspective, just high level on some of the numbers. So if you think about 2017, again, just as a benchmark, which would be the year before they went public, they did $640 million in revenue. This year, 2024, we think they'll do roughly $1.8 billion. So they've grown their revenue at about a 16% CAGR over that time frame. Their operating profit, so their EBIT, was around $77 million in 2017. That's about a 12% margin. This year they'll do around $300 million. That's our forecast. So a little over 16.5%, almost 17% margin. So operating profits have grown north of 20% in terms of a CAGR. And so your margins have gone up. That 450 to 500 basis points has basically been the operating profit growth, or operating margin expansion. Gross margins have gone, as I said earlier, from around 46% to 58%. So they've gone up about 1,200 basis points. I think as we think about that growth, probably there's a few things to think about. First of all, the channel mix of the business and the product mix. So from a channel perspective, direct-to-consumer sales carry about 10 to 15 points higher gross margin than wholesale. That maybe accounts for maybe close to half of the margin improvement that we've seen. Because if you think about in 2017, 30% of Yeti's sales were direct to consumer. Okay, and then the other 70% was just selling to retailers who then sold it to us. Right now, that number is 60% DTC. So Yeti's able to capture a much higher margin on more of their sales than they were before. The other dynamic would be their product mix. So drinkware was about 50% of their sales back in 2017. So You think about that. 2 years after they introduced drinkware, it ran to 15% of sales. That's how successful that drinkware launch was. But that now stands at 60%. So that's continued to kind of migrate up in terms of the mix. And, it's not as big of a gross margin difference, maybe like 500 basis points, drinkware versus the coolers and equipment. So I think those are, that's kind of I think maybe just the easy to understand, like why are margins higher? Well, part of it is channel mix, part of it's product mix, but there's also sourcing improvements, as they get bigger with scale, working with more vendors, being able to get better pricing. I think if you look at, even within their cooler base, the cooler suppliers, historically 70-80% of their coolers would come from just their top two suppliers. I think that's down to like less than 50% now. They're working to diversify outside of China, so we can talk about all that. But so there's sourcing differences that allow and basically scale. But then the last thing, Tuck, that I think is really interesting, and maybe one of the more underappreciated parts of this business, is the idea that none of the product they have is perishable. None of the product they sell is channel specific. None of the product they sell is geography or country specific. Like, they have a lot of flexibility into how they allocate inventory in a way that it doesn't require meaningful clearance or markdown activity, unlike other brands in the market, which may have, spring product. And once that's gone, you got to get rid of that to make way for the summer or the fall. Or if it's perishable product, obviously you got to sell that before it goes bad. This Yeti product is none of that. And so as long as they're being responsible on how much they are producing, they can be pretty nimble moving things around to different channels and countries where the demand warrants it, and not have to take big markdowns. I think that's another part of the reason why Yeti's been able to sustain premium margins.
Yeah, that's a really good point. And those are the things that I love to talk to experts like you about, to figure out, like, how did this get to be the way that it is? That's a really important point. I guess the other thing that comes to mind is, with this particular management team, resiliency comes to mind, because they dealt with a really serious channel inventory problem that made them change direction in their business model. And you want to describe that a little bit, because I think it's a great lesson learned for those who are, managing a company or looking at companies that have a transition like this.
No, I think that's great. So as I mentioned, I've probably known this company for around a decade. So they IPO'd in 2018. They were considering going public in 2016. So after the drinkware introduction, and that's what you're alluding to, is the success with drinkware created basically a channel inventory issue where retailers were over ordering because they thought they would be short shipped. Right, the demand for Yeti drinkware was so high that demand was outrunning supply, and Yeti didn't have the capacity to fulfill all the orders. Well, of course, you get to a tipping point where all of a sudden the supply does come online, and a lot of retailers were ordering more than they really needed, and you got into that issue. The other point that happened was, Yeti had a lot of small independent retail partners that they were dealing with. If you go back to the origins of the business, remember, they were only going after really the hook and bullet crowd. So there was a lot of smaller mom and pop fishing stores, hunting stores that were the ones selling this, not the most sophisticated of partners, but the ones that were authentic and right in their wheelhouse. Well, that created a challenge too, tracking the inventory, what was there. If you fast forward to today, they've shrunk that base dramatically, and they now, partner much more with some of the larger players domestically, Dick's Sporting Goods, et cetera. But when you think about decision points and management, I think this was a great insight into their CEO, Matt Reinsch, because he had just joined not long before this IPO process had started. The initial IPO, they were thinking of going public in 2016. Matt made the hard decision very close to the time this IPO was going to launch to basically call it off and say, you know what, we need to get this this kind of drinkware business and inventory situation figured out. It hadn't really become a full-fledged problem yet. He just had the instincts of like saying, you know what, we need to hit a pause here. And I think that was the first, I had just now met Matt but it really showed, I think, just the true character of him and his management skill. I mean, he came up at Danaher, which has a long history of developing very capable managers. And, Matt made the hard decision and it turned out to be the right one. So then when the company came public in 2018, things were much more settled and he was able to execute against their plans. So I think management at the top here is really one of the bullet points I use when I talk to investors. This Matt Reinsch, I think, is a great CEO and someone you'd want to invest behind.
Yeah, no, that's a great insight into sort of obviously a difficult situation, but also just as you said, high character, great leadership, just making sure that let's make sure this is right before we go out to do something different here in terms of being a public company, because not everyone's set up to be that.
Yeah, no, and look, he did that again a couple of years ago with the soft cooler recall. They had these, the magnetic top coolers, the mag tops, and they made a proactive decision to recall that family of product, which was extremely successful for them, just because they were, there was the risk of some of the magnets dislodging, and it hadn't happened in any material way. But again, getting back to kind of his Danaher background, and he had brought in a product quality person and to work with them, and their idea was, hey, we need to ask the question, not what has happened with these products, it's what if. And it's just a different mindset, and it kind of puts into perspective the way Matt thinks about this brand and trying to protect it and trying to protect consumers, that they proactively recalled some of their most popular products to re-engineer, the casing for the magnets. They didn't have to do that. He did it on his own, or they did it on their own. And so another decision point where Matt made a decision that I think is right for the long-term health of the brand, but certainly not something that's popular with investors in the short term. Yeah,
agree with that. And yes, that's what builds the long-term value over time. You don't want any deterioration in the brand is obviously going to be a bigger problem down the road, even if you sell more in a particular quarter. Totally agree with that. I agree with you. I think it's an excellent management team, great leadership. I think that they continue to layer on good decision after good decision. Maybe if we talk just for a couple of minutes about the operational excellence piece of this. So you mentioned, obviously they've gotten some gross margin that we talked about, and then the operating profits have grown, but they've also been plowing back a lot into investing in this business. Mm-hmm. And, what are some of the things that you think are most important to think about framing this as investments that not only create future growth opportunities, but also optionality in terms of maybe having the growth rate stay stronger for longer?
Yeah, no, it's they've been investing a lot in infrastructure, whether it be supply chain, whether it be international, and I think that's a big part of this. Technology and systems, developing the CRM capabilities to take advantage of all that data they're getting now that they're so highly penetrated with DTC. These are all things that I think will create stronger customer engagement, better understanding of the consumer's journey through the brand. So I think from a system standpoint, that's pretty straightforward. I think they're still in their early innings of getting to where they want to be from that perspective. I think in the last few years with, really strong gross margins, it has allowed them to invest aggressively within SG&A. I think the way management thinks about margins is, I think they think about the operating profit margin and that they believe that should migrate higher from here. To this point, that's been a lot of gross margin. I think if you look forward over the next 3 to 5 years, in my view, there's certainly more upside to gross margin, but I think there's a lot of opportunity on the SG&A line to start to generate some leverage because they've invested ahead of what should be I think, several years of pretty high growth in their international business. If you just think about, less than 20% of Yeti sales are outside the United States. That number in 2017 was like 1%. So it's grown, but it's still just a small amount. If you think about, some other brands in the marketplace, like a Lululemon is probably 35% international. Acushnet, which is kind of a hard goods brand, Titleist, those types of things, is north of 40% of sales outside the U.S. Nike is over 55% outside the U.S. So Yeti at sub 20% international penetration is still pretty low, and the majority of what they're selling internationally is in Canada and Australia. And if you think about it, Canada and Australia have the two smallest populations and addressable markets for these products of any country on the roadmap for Yeti. I think Australia is about 25 million population. Canada is around 35 million. So call it 55 million combined. The UK is 65 million. They're moving aggressively into the UK now. Germany's 85 million. I mean, Japan is over 120 million, not to mention potentially China and Korea. And so Yeti, the growth runway for Yeti's international business, we think is significant. We think it probably can grow 25, 30% a year for the next several years. That would support probably mid-single digit revenue growth alone for the company. But back to your initial question, they've invested a lot in building the brands on the ground in these markets. What they don't do is sign up a bunch of distributors and just send a bunch of product to a foreign country and let the local retailers sell it. That's not what they do. What they do is they go in, they build Yeti.com for that market. They develop an ambassador base of folks inside those markets. So in Germany, they're going after the best, the best mountain climber in Germany and the best alpine skier, and they're not using the person from the US or the person from Japan or from Australia. They're building an authentic brand presence in each of these markets. It takes time. It takes money. They've recently restructured their leadership so that they have brought in a head of Asia, a head of kind of the Europe region, and a head of the Americas to kind of understand strategically how to grow each of those. And so I think the investment's been laid down to really support what I think is one of the most exciting parts about the Yeti story for the next 3 to 5 years, which is the growth in international. So I think, to wrap it up, Tuck, I think as you think about this business going forward, I don't think gross margin is necessarily going to go up every single year. There will be ebbs and flows. I think it migrates higher over time. But I think EBIT margins have the ability to move higher, even if gross margins take a year off or that type of thing, because I think there's leverage opportunity in the SG&A line.
Yeah. Great points. That seemingly is the path to having this company surprise on the amount of growth for longer. Because if you just arrange it thinking about this as a U.S. opportunity, it may have some limitations depending on what happens with new product launches. However, that international opportunity is, that's quite an important one to know about.
Yeah.
The other thing that they have done as part of their business that sort of is laying in the weeds a little bit, I know you and I have talked about this before, is their use of data and using that to understand or inform them about what they want to do with new product launches or if they want to expand certain products. Also with the inventory side, we already talked about that, where they made that shift away from the dependency on the channel, maybe to doing more direct to consumer in addition to using the channel as good partners. So if you could talk about the data piece for a minute, I think that would be good for everyone to hear.
Yeah, I mean, I kind of view it two ways. One, it's what people are buying and how they're engaging with the brand, and then the second would be maybe where the brand has permission to go. So if you take the first part, as I mentioned earlier, the fact that they're now 60% DTC, the amount of data they're getting on the customer and what they're buying, when they're buying it, how they're searching for it, I think is just providing Yeti with such much better insights into the consumer behavior and how they can go about, further expanding their wallet share with those customers. Because a lot of times, we're buying products, consumers buying products for themselves, but Yeti is a very giftable product as well. So oftentimes, you can see when the customer is buying something, but they're sending it to an address that's not their billing address. You can start to get, behind the psyche of the consumer and what are they doing and how they're engaging. So I think that's again, I think we're still in the early stages of their ability to really use that, data and turn it into information and actionable information, which then can create kind of a CRM loop for the business. So that's kind of one side of it. But the way they use data is to test maybe new product categories or items that and see what the consumer response is. I think probably the best example of that would be the cast iron skillet that they put on the website. This was probably a little over a year ago, in partnership with a company called Butterpad Industries. So Yeti put on their site this cast iron skillet, and if I recall correctly, it retailed for somewhere around $400, and it was Butterpad Industries skillet. They were kind of highlighting it, putting it on the Yeti platform, and the initial response I got from some investors was like, what is this? Like, Yeti has jumped the shark here. They're going into $400 skillets. Like, this is crazy. They've run out of growth. Like, that was the kind of the negative narrative around it. Well, of course, what Yeti was doing was, they hadn't, manufactured, a significant number of these. They were just testing basically the waters to see what kind of response from their community, what kind of response this would generate. And it was significant. Product all sold out immediately. And, what you could tell from that experience was, hey, a lot of Yeti's current customers are, hikers and campers and hunters and fishermen. They love to do outdoor cooking and they like high performance cookware, and so fast forward to today, they actually purchased Butterpad Industries earlier this year, and are now rolling out a line of Yeti skillets. Now, the price point, when it came out at $400, caused me. I sat back, wow, that seems like a lot. But I was like, I frankly will be honest, I have no idea how much cast iron skillets cost. And so you go online and you can find them for $30 or $40, $50 on Amazon, but you can also find cast iron skillets that are $700 and $800. And so, I think Yeti they're very thoughtful about product innovation. And I think they're using data to help inform them, where they're maybe allowed to go and where maybe they should stay away. But that's how I kind of view their use of data at this point, Tuck.
Yeah, interesting. I mean, to me, I spend time outside of consumer and a significant amount of time thinking about what the impact of AI will be and thinking about investments. But there are a handful of great brands, thoughtful management teams that could be big beneficiaries of AI, it seems to me. And this one would be on my list.
Yeah, I mean, look, AI, it's such
AI?
Yeah, AI it's a topic obviously that's taking on a life of its own, and in a lot of the work that I've done with companies that I engage with, there's a lot of AI that goes on really behind the scenes, right? It's in product development, it's in consumer analytics, it's in just manufacturing, right? We've spent a lot of time with Walmart, and know what they're doing with automation, but then you have an AI behind that, and so there's just a lot there. I do think AI is going to find its way into helping Yeti as it would with most of the companies we track. I'll be honest, I haven't heard them talk a tremendous amount about it. Something certainly to watch, but look, I think AI has the promise of it's basically creating more efficient, more productive operations. And to the extent that that's going to help, the Yeti brand, and as it expands, I'm sure we'll hear more about it in the future, and something we'll be watching for sure.
Yeah, absolutely. So, yeah, I mean, just sort of just to, sort of wrap it up, are there any other things that we haven't discussed that you find to be, sort of really unique features of this model that you find to be surprising to folks that want to dig in?
Yeah, I mean, I think the product innovation pipeline and how it's developed, and I think that's something that folks kind of maybe struggle with, because I kind of think of this as it's just coolers and drinkware and that's it. But then you start to peel back the onion, even within those, this is a much more robust business than maybe at first glance. If you just think about drinkware, for example, I mean, they have, over 50 core drinkware items. If you listen to most people in the investment community, they kind of feel like drinkware is, a handful of items, and, the Stanley thirst quencher is going to destroy demand for the Yeti product. Well, Yeti does have some overlap with Stanley, and Stanley's been a big success, but Yeti's more than just, 20 to 30 ounce straw drinkware. Like, they have evolved that assortment to now more recently include more group drinkware product. Think about pitchers, you think about the ice bucket, you think about the wine chiller. More recently, the French press, which just came out. Another item, which I'll be honest, when I saw that come out, I had a little bit of the cast iron skillet, like, a French press? I'm like, really?
Yeah.
Well, I don't drink coffee out of a French press. However, people that do rave about it, and that includes folks like us that are in the financial community in front of computers a lot. I've talked to any number of portfolio managers that have those now on their desks. It keeps the coffee warmer for longer, as you would expect. They love it. But also, this product the idea actually came from some of Yeti's most extreme outdoor ambassadors, folks that were out in the wild for multiple days looking for ways to keep their coffee warmer for longer. And so, you sit back and go, wow, like French press is something that's in an office environment or your home. And you're like, well, no, it's also in the wild. So it's been a huge success. It's an early product, but I think it gives you an idea that, this company is so much more than just very simplistic views of hard coolers and, core drinkware. The aperture of the brand, I think, is very wide. And so I kind of like to talk about that. I think the bag business, the opportunity in bags is significant.
Yep.
This might be a good time to talk about how they use M&A to accelerate or enhance that product innovation pipeline. I mean, they have a pipeline that goes out 3 to 5 years. Yeti. If by virtue of their success, right, there are scores of companies in the market now that want to be the Yeti of fill in the blank.
Right.
Yep. And so there's people out there creating great product, and to the extent that Yeti has those types of products on their innovation pipeline, let's say it's out 2 years, 3 years, 4 years, 5 years, they'll be considerate of saying, hey, does it make sense for us to kind of just wait and roll out our own product in 3 or 4 years? Or is this brand or is this product that someone else has produced basically Yeti ready? And would it be better for us to buy that company that maybe has, or that product that has, a handful of thousands of folks following on Instagram and that type of thing, bring it in-house, use it as the anchor for the Yeti product, and then put it onto Yeti's social media and advertising platform, which in and of itself, over 2 million Instagram followers, and the whole Yeti media, storytelling capabilities, and you can explode demand for these products. I think that's kind of what they're doing with Butterpad Industries and the skillet. They earlier this year also purchased Mystery Ranch, which is a very high-end manufacturer of backpacks, and they're based in Bozeman, Montana. Great brand. The people who know it absolutely love it. Mm-hmm. But guess what? Most people have never heard of Mystery Ranch. Well, I think as you look into 2025, so Yeti purchased them earlier this year. I think a lot of those products were the type of things that were on Yeti's roadmap for bags over the next several years. But by buying Butterhead Industries and bringing in their product development expertise, they can now go into 2025 and have an expanded launch of Yeti bags, which leverage a lot of this IP and these design patents and capabilities, and kind of accelerate the growth in Yeti's bag business with some folks that have already been very successful. So I view M&A as basically strategically accelerating product innovation that's already on Yeti's roadmap, and or some sort of maybe a technology capability or something that allows them to maybe operate the business more efficiently and more effectively. But yeah, I mean, those are the types of discussions that go on where people, I didn't realize that, or I didn't appreciate the fact that there's 55 drinkware items, not just 3. And so it all gets back to a very thoughtful management team that I think has sights on being able to grow this brand at a nice clip for the next several years. I think the company needs to do an investor day, which I think will happen next year, where they kind of lay out their new long-term algos and those types of things. But at the end of the day, there's no indication to me that Yeti is setting itself up to be a low-growth company for the next 3 to 5 years.
Yeah, I think that's a really super important point, because they have sort of gotten to this point where the business is big enough, the brand is well known enough, and they generate enough cash that they can do some of these acquisitions that can become 1 + 1 = 3, rather than doing it as a defensive move, right? They're not making sort of a big quote unquote transformational acquisition. They're making, sort of in the Jim Collins framework, they're firing bullets before cannonballs.
Mm-hmm. No, I think that's exactly right. And I don't think Yeti, as they think about acquisitions, right? It's about accelerating the product innovation pipeline. And I think Matt likes the idea of being a single brand business. He also spent time at Vista Outdoors and ran a multi-brand outdoor business. So he's seen multi-branded businesses, and he's also seen Yeti with kind of the single brand. I think he likes the single brand. I think that's generally where he's going to continue to carry this. And I mean, you talked a little bit about the cash flow. I mean, look, the other part of the story that I think needs to be told is the strength of the balance sheet. Net cash on the balance sheet. They generate a significant amount of free cash flow, probably $150 million a year.
Well, Pete, this has been an awesome discussion. Thank you very much. I always love to talk to you about companies and talk about some of these details that are, sort of not well appreciated, because you really know these businesses very well, and that came out today. So really appreciate your time, and thanks everyone for listening in. Take care.